Thanks, Paul. Morning all. Gold, what a great time to be in gold and be a producer. We also just put out record production in the month of March. So from that side of the fence, all going swimmingly. I'd like to thank Hedley Widdop. He gave me a good G up with all these footy terms just at the back there coming on. But Hedley, I'm actually a rugby man, so it was lost on me, but thank you anyway. Most impressive. So here we are, high gold price, record production and a share price that's pretty well near record lows. It's a real quandary what's going on here. So I want to take you through what has happened, where we're heading and why we do believe we're at a true inflection point for the company. And as Paul said, the only way is up from here. So market cap around 100 mil, debt of 60 mil, some outstanding hedges of 78,000 ounces. And I'll move on with the detail of that a bit later. For those of you that don't know Calidus, we're up in the Pilbara of WA around Marble Bar. We've been up there since 2017 and over time we've been consolidating the area. So we have an operating gold plant at Warrawoona in the sort of pinkish red there, where our main deposit is at Klondike. We're mining a little satellite deposit to the west-southwest called Blue Bar in the green. That'll be complete in June, just providing a grade sweetener. That's with a Haoma joint venture, and I'll talk more about that. Bamboo Creek up to the northeast, it's produced a couple 100,000 ounces at near 10 grams. We're looking at a deposit up there called Bulletin, which I'll take you through in more detail. And most recently in December, we bought the Nullagine Gold Project about 70 k's to the southeast of us. That's got a 1.8 million tonne per annum mill, historic resources. And our Blue Spec project, which is a 24 gram deposit down there, and we'll talk about some more of those in detail. So where are we heading? Well, we're at 60 to 70,000 ounces per annum at the moment, aiming to be at 120,000 ounces in 3 years. So how do we get there? It's a combination of those high-grade satellite deposits, mainly Bulletin, but then heading underground at Klondike beneath the main pit and underground at Blue Spec, a 24 gram deposit. That builds your production. And with that, we're seeing a drop in the all-in sustaining cost. More ounces, same cost means less cost per ounce. But also we're through our cutback on our main pit, so our material movement's dropping, our grade's been improving, and we'll talk what we saw in the March quarter shortly. Just out of interest there, the yellow line, that's actually the forward curve on gold. So you see that's out of date now. We're obviously at 3,500 today, so that's pushed up some more. And where our all-in sustaining cost is heading, there is a rather large margin to be had. March quarter we put out this morning. We've had a bit of a slow start in Q1 and Q2 as we were getting through a cutback. We always said that that'll be complete this quarter. It is complete. We started to see the benefits of that this quarter. And as I said, just under 6,000 ounces in March, and we'll do more than that in the coming quarter. Why do I say that? Well, we've got an extra 7,000 ounces coming in from the high-grade Blue Bar satellite pit. So combine them together, that's why we're confident that the next quarter will be our best ever by quite a margin. Mentioned the reduced BCMs are dropping down, costs are dropping. All of this means is the margin is increasing. Just some pretty simple sums before we get on to hedging for you. So if you look at that and you say, let's make the maths easy, 20,000 ounces at 3,500 an ounce for the quarter, that's $70 million of revenue. Our site costs run at around $13 million a month, so 39 for the quarter. That's a 30 million cash flow if you're selling at spot for the quarter. And I say if and spot, and I mention them because that's been one of the the holdbacks on us has been a hedge that we had to put in place as part of our original financing. We did rip the Band-Aid off a few weeks ago, and that's why our share price is where it is today. We had to do quite a discounted raising to get a bit of give and take in this world. We did a raising that got us through the March repayment, and as part of that, our lenders have agreed to roll out 21,000 ounces of hedges from this year, defer $11 million of debt repayment. As we speak today, with the current gold price, that's worth over $35 million extra cash flow to us in this coming year. So as long as we're feeding in just a reasonable amount into the hedge, we'll chip away at that. That'll be gone in 18 to 24 months, and then we'll be fully at spot thereafter. So there is a cap on us because of that, but the fundamentals of the underlying business are sensational. It's really just making sure we chip through that hedge profile in the interim. So if you combine increasing grade, lowering costs, hedge rolling out, that's why we're saying we are at this true inflection point for the operations as we speak today. Talking of the operations, how are they looking? This is now probably 4 weeks old. We've got one long pit out at Klondike. It's a nice simple operation, tiered down. We were doing a cutback. As I say, that is complete. So we're really fairly all bound. You'll see that in our upcoming numbers for the March quarter. Our strip ratio is plummeting at the moment, and it's becoming a lot simpler operation to manage, and we're into the guts of the ore body proper. And this last March quarter, the improved performance is solely on the back of the Klondike open pit. We're not really seeing any of the satellite pits coming in yet as an ore source. So that improved performance is on the back of this. And the team up at site and our contractor McMahon's have been working very hard over the last 3 to 4 months, redoing our planning systems, working out where we're going, how we're mining, and we're really starting to reap the benefits of that now. Just briefly on the Haoma joint venture, that's 60% profit share to us, 40% to Haoma. We're doing a little pit called Blue Bar, 20 k's away. It's a 2-gram deposit. That'll be mined out by June, but it just provides a nice little sweetener in grade and a good test case before we start doing bigger satellite pits. That's on time, on budget, on cost, and the grade's reconciling as expected. So that's good. There's a lot of other targets in that joint venture. Bamboo Creek, where I had the pleasure of working as a student on a 3-month on, 1 month off, I think it was the roster back in the day, and they did 220,000 ounces at 9 grams, and it hasn't been mined since 1993. So what's out there is pretty exciting. So we continue to work with Haoma on unlocking value across their portfolio. This is the next deposit we'll be tackling at Haoma. It's the Bulletin deposit, 100,000 ounces, 4 grams, open at depth, some stonking intercepts that you're getting up there. Low all-in sustaining costs, $1,700 an ounce. So that's just a cash printing machine once we're into it. We need to get that permitted. That'll be by the end of the year, and as soon as that's permitted, we'll be in a mining Bulletin. Klondike Underground will become a baseload as we start winding down the pit, but that's a couple of years away. Standard sub-level open stope just beneath the pit. We'll do some more drilling. We'll start getting an exploration decline down there at the appropriate time, and we see that providing sort of a 1 million tonne per annum baseload feed for the Warrawoona mill. We're moving to southeast around Nullagine, Blue Spec. If you remember, I talked about a 24-gram deposit. This is a gold antimony deposit, so we do need to have a float circuit associated with it. But 24 grams a tonne is, I think, about as high as you'll ever come across in Australia. Comes out at about 11 grams a tonne diluted. Initial 4-year mine life, open at depth, and just a solid little earner as Blue Spec. But I think more exciting is the area around Blue Spec as well. Immediately along strike, about 4 kilometres along strike, we've found a new discovery core that we call Felix. Some beautiful intercepts there. We've been doing a lot of infill soils and structural mapping over the last 12 months, and we'd like to undertake a decent drill campaign out there this year and start bringing that into resource. What we want to do around Nullagine, though, is it's a lot bigger picture. Now we've picked up this whole new tenure. There's historic resources out there of around 1.4 million ounces. There is a 1.8 million tonne per annum mill. I was down there last week with Richard McLeod, our COO, and the mill's in great nick. It's only closed down a couple of years ago. The bulk of the production was done sort of around 2012 to 2019 in this area, where gold was 15 to 1600 Aussie an ounce. At $3,500 an ounce, there's so many possibilities out here. Our geos on the ground, already out doing soil sampling and rock chip rock chipping around. Within 2 k's of the mill, there's deposits that have been drilled by Novo and others that we're now just extending out. And we look forward to starting to announce some of these resources and some of these reserves over the next few months, because what we're seeing at Nullagine is a real opportunity to boost our production in the very short term. We're looking at a sort of 2-week on, 2-week off campaign basis through that mill, feeding some of these oxide deposits so we're not overstretched down there. We're just keeping it a steady production rate. But if that can add 30 or 40,000 ounces per annum to us, no debt in this asset, no hedge on this asset, that's just money for jam. So that is an absolute focus of ours. And then longer term, can we look at turning this mill into a float circuit where we start to tackle some of these deposits? It's well known for Millennium they had troubles with recovery at depth. That's because they didn't have a way of treating the sulphide. We're looking at a float plant for blue spec. Maybe we turn Nullagine into a float plant, and not only can we treat blue spec, we can treat all of the refractory and semi-refractory deposits in the area and have another production hub. And we certainly find that very, very tantalising internally, and think that's got a very high probability of success. Lots of opportunities there. There's known deposits that were half mined when they shut down, easy to get back into. We're running optimisations, mine plans, and we aim to get some of these numbers out in the next few months if we can. We walked down to the portal at Barton's. This was stopped in the middle of stoping. All the infrastructure's there, so to restart some of these deposits, very easy. And again, 3,500 Aussie an ounce versus 1,500 an ounce. They really are tantalising to get up and running as soon as we can. Almost out of time, so just also briefly touch on Pyrrha Lithium. We own 40% of a private company called Pyrrha. We put it together with Haoma, and then SQM has come in as a partner with 40%. Huge ground holding across the Pilbara. A lot of it was ex-gold tenements that we held that turned out to be prospective for lithium. It's got $5 million in the bank itself, so it's well funded. Our main focus at the moment is West Pilbara lithium, a long strike from Wildcat. So yes, lithium's had a bit of a tough time, but I think last I checked they were still up around 800 million market cap, and they're just a long strike from us on the Tabba Tabba Shear. We would like to be drilling there in the first half of this year. We're just waiting on heritage surveys, and we'll see what comes from that. But if you like, it's a free option in Calidus for exposure to lithium. Lots of other areas around old tin tantalum workings in the East Pilbara and around Global Lithium's Archer deposit. So that's got its own geos, it's got its own budget, and we're a passive shareholder, and we'll see how we go with that. So that's a very brief run through of Calidus. It has been a pretty torrid time the last 9 to 12 months for existing shareholders. Bit frustrating when we know that the operations are humming. We're seeing record production, record gold prices. Now that we've taken the shackles off with that tweak on the financing, pushing out hedging, pushing out debt, we are super excited about the year ahead and the opportunities we've got through Nullagine, Haoma joint venture, lithium, and can't wait to get cracking. Any questions, come and visit me at the booth, please. Thank you.